So in this video, what I want to talk about is, would you rather have your $100,000 emergency fund sitting in a high yield savings account, or would you rather have that $100,000 emergency fund in a high cash value whole life insurance policy? So I'm going to go over a couple of the key differences between the two. So we'll start off with the high yield savings account. So let's say I've got my $100,000 in my high yield savings account and I'm earning 4% interest on that. And that would be $4,000 in interest I'm earning. And at the end of the year, I would have $104,000. Okay, so that's assuming I'm not touching the money again. It's an emergency fund, it's money that's most likely just going to sit there. So at the end of the year, yes, I have $104,000, but guess what? I'm gonna have to pay taxes on the $4,000 in interest I earned. So let's just say, for easy math, I have to pay on that $4,000 in interest. I have to pay 25% in taxes. So that's $1,000 in taxes I'd have to pay. I have a true ending balance of $103,000. So that's one thing. No matter what, if I don't touch the money in there, I'm still going to have to pay taxes on the interest that I'm earning. And the other thing not to mention is this 4% interest rate that could change. Next year, it might be 3%, it might be 5%, it could go up, or it might even be lower. So that's something else to keep in mind is that the interest rate that you earn in a high yield savings account that can change. Now, if we're going to compare this to a high cash value whole life policy, let's say I've got the $100,000 in a whole life and I'm earning 4%. That's going to give me the same amount of $104,000. It's $4,000 in interest earned. Now, the difference is that 4% that I earned on my money, I'm not going to get taxed on that. That's going to continue to grow tax deferred for me. So if I don't touch the money in my whole life policy, the interest that I'm earning, I'm not going to get taxed on if it's set up the right way. And I'll have other videos explaining how these policies need to be set up. But assuming it's set up the right way, I'm not going to have to pay taxes on the interest that's earned in these policies. Now, the other thing I want to point out is the 4% that I'm earning. A lot of policies out there, that's a guaranteed rate. Or you might see a 3% guarantee on your policy, plus you're getting dividends on top of that. So with dividend interest and dividends, you're going to be getting around that 4%. But on a contractual basis, you might be earning anywhere from 3 to 4%. Now, the dividend rates can change. I'm not going to get too in the weeds on that. But when you compare that with a high yield savings account, there are no guarantees on the interest rate you're going to be earning. With a whole life policy, depending on what you have in your contract, you might have a guaranteed rate of 3 or 4% interest. And if you're with a mutual carrier, I'll have other videos talking about that as well. If you're with a mutual carrier, you might be getting dividends on that as well. So, just something to think about if you have an emergency fund or you have a bucket of money that you know you're not going to touch anytime soon and you still want to keep it liquid, there's other ways. There might be other ways, more effective ways to go about that. I hope the video helped. If you do have any questions for me, just leave them in the comments below and I'll make sure to get to them and I'll catch you in the next video.